All right, let's talk about something huge that affects all of us, financial markets. It sounds complicated, right? Well, in the next few minutes, we're going to cut through all the noise and give you a super simple way to understand where all the money and assets get traded. Let's jump in. So, you hear about it all the time, right? The stock market is up, a currency is down. But have you ever stopped to think, where does this happen? I mean, is it a real place? Is it just a bunch of computers? That's the big question we're going to tackle today. The actual answer is way simpler than you'd think. A financial market is really just any place where people who want to buy and people who want to sell can find each other and make a trade. The key word there is any. It's not about a single building, it's about the network that makes these deals possible. Okay, so to really get our heads around this giant network, we need to split it into its main parts. And we're going to start with the first, most important division there is. Honestly, forget all the complex Wall Street jargon for a second. The single biggest way to organize all of this stuff comes down to one super simple idea. Time. That's it. Just how long until you get paid back? And here it is, what I call the one-year rule. It's this simple. If some kind of IOU is supposed to be paid back in less than 1 year, it's part of the money market. If it takes more than 1 year, well, you're in the capital market. Less than a year, money. More than a year, capital. That is the fundamental difference. So let's dive into that first one, the short-term side. The money market is all about fast cash, right? It's for quick lending and borrowing, and everything happens inside that 1-year time frame. So what exactly is being traded here? Well, think of it as short-term IOUs from big players like governments and corporations. A huge part of this market, though, is banks lending money to other banks, sometimes just for a single night. It's kind of like the engine room of the whole financial system, just making sure cash is always flowing where it needs to go. Okay, so if the money market's all about right now, the capital market is all about the future. This is where the big, long-term investments happen that are meant to fund growth for years to come. And yep, it's all for assets that pay back in more than 1 year. Now, this is where it gets really interesting, because capital comes in two main flavors. First, you've got debt capital. This is easy. It's just a loan. A company borrows money, and they pay you back with interest. But equity capital, whoa, that's completely different. It's not a loan. It's ownership. The company is selling you a tiny piece of itself, a stake. And your reward isn't interest. It's a dividend, which is a piece of the profits. And to make this super clear, for debt capital, think of those government bonds that take 3, 5, or even 10 years to pay back. For equity, well, the classic example is buying shares of a company on the stock market. If you've ever done that, congrats, you've been a part of the capital market. And check this out. These assets have this cool two-stage life. First, in the primary market, a brand new share or bond is created and sold for the very first time. Think of it like a brand new car rolling off the factory floor. But after that, it gets sold again and again between different investors in what's called the secondary market. That's what the stock exchange is. It's basically a giant global marketplace for used shares and bonds. All right, so we've got money and capital down. The third massive piece of this puzzle is the currency market. This is where the world's actual money, dollars, euros, yen, gets bought and sold. And it basically happens in two main ways. First up is the spot market. It's exactly what it sounds like. You buy a currency on the spot, at today's price, for right now delivery. Simple. But then there's the futures market. This is where you agree on a price today for a currency that won't actually be delivered until sometime in the future. Which probably has you thinking, why on earth would anyone do that? Why make a deal now for money you won't even get for 6 months? Well, it turns out there are two very different and pretty fascinating reasons. First, meet the hedger. So imagine you're a business and you know you have to pay a supplier overseas in 6 months. You're nervous that the exchange rate might go against you and make it more expensive, so you use the futures market to lock in today's rate. You're not trying to make money, you're just trying to protect yourself from risk. You're hedging your bets. And then, on the complete other side of the coin, you've got the speculator. This person isn't trying to avoid risk. They're running straight towards it. They're basically a gambler. They are betting that an exchange rate is going to move in their favor. So they agree to buy at today's low price, hoping they can sell it for a much higher price down the road and make a nice profit. And there we have it, the money market, the capital market, and the currency market. So let's zoom out now and put all these pieces together for the big picture. This chart just sums it all up perfectly, doesn't it? You've got the money market for short-term stuff under a year, the capital market for long-term investments over a year with both loans and ownership stakes, and the currency market, which lets the whole world trade with each other and lets people make some bets. 3 different markets all working together in one giant economy. And really, that's the thing to leave you with. From the interest rate on your savings account, to the value of your retirement fund, to the price of that phone you bought that was made overseas, these markets aren't just some abstract thing. They are shaping your financial life every single day. So the question is, how do you see these huge forces connecting back to you? Thanks for watching.